on to a call ratio backspread. It's just a very bullish investment strategy that combines options to create a spread with limited loss potential and mixed profit potential. It is generally created by selling one call option at a lower strike, same expiration, meaning an option with a little more value, and then using the collective premium to purchase a greater number of call options at a higher strike. So a lot of times the out-of-the-money calls is what we're going to purchase, which are lower priced, but we're going to buy multiple of them against the one we sold. This strategy has potentially unlimited upside profit because the trader is holding more long calls than short ones. So more long units than short units. An investor using this strategy is expected an exaggerated move in the underlying assets, so we want a big pop, preferably upside, and will profit from a combination of the adjustments, either taking off the profits or morphing the position into another strategy that we've talked about, or another way to lock up our potential profit. So what we're going to talk about on the call ratio backspread to the upside is we're going to discuss Caterpillar. And we're talking about the stock, which is 82.38 as of the close today. We've got a dollar weighted put call ratio of 0.80, and there's 36 days left because we're going to deal it in December. And what we're going to set up is a backspread where we're going to talk about selling 10 calls of the December 80 strike at $4.10. Delta is 0.65. We're looking at a vol about 26.48. Theta, gamma. We're going to buy a multiple of 30 calls. So basically 1 by 3 is the ratio. We're going to do 10 by 30. December 85 calls. So you can see we're selling a call that has a little value in the money with premium, and we're buying calls that are out of the money. We're purely buying premium, but we're buying a multiple of them at a lower price. $1.57. They have a delta of 37.37. Vol 25.26. The theta and the gamma. Now, the total cost of this spread is $6.10 on our 10 by 30 ratio. If you did 1 by 3, we're only talking 61 cents. Our total delta is going to be positive 4.6, or in this particular case, because of the multiples, 460 delta long. Now, when you talk about 460 delta long, you're talking about being long 460 shares of stock, roughly. Now, the important part of backspreads is volatility. Now, if you look at our volatility, the call that we're selling is 26.48. The one we're buying is 25.26. Now, this is what's very important about all backspread trades. This is what's important about all trades that deal with volatility. If we're buying volatility, we want to be able to go in there and get long volatility at a volatility range where the implied is trading near a historically low level or below the historical low level. We want to be able to try and do these backspreads where the skew, which is the difference of the one, the call, the 80 is 26.48, the 85 call is 25.26. We want that skew to be very tight, meaning close to each other, because we don't want to be selling, we want to sell the call that we're selling at a higher vol to collect, right? And we want to be able to buy the one that's cheaper at a lower vol. You're not going to see a skew very, very wide, okay, the difference of these two, when you're going one strike next to the other. It's when you create backspreads that are strikes apart that you've got to pay attention to what these implied vols are versus what the historicals are. Because what you'll notice, and what we've talked about, what we've seen when Fari's talked about these high flyers during the earnings cycle, these vols, they explode 2 or 3 times 2 or 3 days out before the earnings cycle. So you need to have an understanding, and you need to pay attention to these vols and how they move. Now, when you play the options and you play these high flyer stocks or you play these earnings cycles, it's important to keep track of what these levels are historically and watch them change as they move into the week before the earnings cycle, 3 days out before, 2 days, 1 day, and then the amazing piece is watch what happens to those volatilities come the day of earnings. So we want to capture the ability to get into a backspread where we're taking advantage of lower level vol that we're buying, okay? Because remember, when you're buying vol, you're paying for premium. When you're paying for premium, you're paying for option decay. Look at the daily decay down here. Okay, we're collecting $36.89 a day for selling 10 of these 80 calls at $4.10. If you look over to theta, you can see where that number is coming from. That $36.89 is roughly the multiplier of the 10 calls times the 100 multiple times the theta per day. Per day meaning 36 days is where it's breaking it down. When you do the math, if you were to multiply the theta times the calls times the multiplier times the price, it would work out to $36.89 on a linear numerical decay. Doesn't always work that way. Why not? Because that 26.48 vol and that call that we sold, it could change. It could go up, which means we're going to collect more money. Or it can go down, which means we're going to be collecting less. Same is true on the buy side. We're paying $103 for those multiply 30 calls, which is 3 times, at $1.57 for that period of 36 days in December, at that rate of 0.0344, which is the theta. Now, if vol pops, what's going to happen? Well, you're going to lose on the one that you sold, but we only sold 10, but we're long 30. So we're going to actually make in any vol pop because of the fact that we have a long multiplier of more units. How many units are we long? Net 20. So we're going to benefit if volatility pops up. But right now in our equation here, you can see we're paying $66 a day for a 10 by 30 backspread in a ratio in Caterpillar that we have done in this particular trade. Now, what are we looking for? Obviously, we want a strong surge upward. We want a quick pop in vol. We want a quick move on the upside. And what that means is that our position, this 460 delta is 4.6. What happens with calls on the upside? The call vol increases possibly or goes down, okay, depending on how quick the move is. But what's happening? We have gamma. We have gamma. Gamma is a backspread's best friend when the stock's moving, and it's its worst enemy when the stock's not moving, because I'm paying that $66.20 a day. So I'm paying for movement. I'm paying to have an expected move in the stock. Now, what do I need to do? I need to react to the movement of the stock. And what we're going to do is talk a little bit about that. When I show you a plot and explain to you what are some of the ideas, what you need to do, what you need to look at, we're going to show a couple plots that will show what happens when vol goes up, what happens when vol goes down. You'll see the look of the graph to understand where the profit levels are. But a lot of a backspread's value is A, how you create the position initially, B, how you manage the adjustments, and C, know when to get out because I've made enough money and I'm on my way to the next trade.